Hello, this is Sal Guatieri, Senior Economist, BMO Capital Markets. After 7 years of near zero interest rates, the U.S. Federal Reserve finally looks set for liftoff. Should you be worried? Not really. First, this is likely to be one of the mildest Fed tightening cycles on record. But don't take my word for it. Even Fed boss Yellen says she's planning a very gradual course back to rate neutrality owing to global headwinds and the strong U.S. dollar. We see the Fed funds rate rising only 1 percentage point by the end of 2016. This compares with a 3 percentage point increase during the similar phase of the 2004 tightening cycle. Second, even as the Fed taps the brakes, the Bank of Canada will likely stay in park. Elevated unemployment and concern that oil prices could fall further and depress growth will make the bank very cautious about raising rates. Finally, even as the Fed tightens policy, other forces will act to tamp down the increase in longer-term rates. Many other central banks, including the ECB and Bank of Japan, are easing policy to spur growth in their economies. Negative interest rates are not uncommon across much of Europe, making Canadian rates relatively attractive. Secular forces are also holding down bond yields. Aging populations have less demand for loanable funds. A more indebted global economy needs to restrain borrowing, with governments in many countries looking to pare budget deficits. Most importantly, one of the biggest drivers of long-term rates, inflation, will likely remain depressed for some time due to the forces of globalization, automation, and intense retail competition driven by online sellers. The so-called sharing economy is also keeping a lid on inflation by expanding the economy's capacity and flexibility to meet demand without resorting to price hikes. So to wrap up, interest rates might be going up, but don't lose a lot of sleep over it. Thank you.